So, good evening everyone. You're all very welcome to this week's webinar. Good evening everyone. Apologies for the technical issue there. We just had some issues with our screen sharing, but all seems to be back as normal. So as I said, all very welcome to this week's weekly market webinar. A very busy week ahead on all facets of the markets. We have FOMC, we've got central bank meetings, a lot of intraday volatility, of which we will be going through tonight. So even today alone, before we actually look at the rest of the week, which we'll be doing shortly, we've had an incredibly volatile first couple of days in the markets. We've seen European assets really struggle on the back foot this week. We've had obviously S&Ps, NASDAQ, a little bit of a variation of moves there, which we'll be going through shortly. And of course, this is obviously something we need to get ready for as we move into tomorrow with the FOMC. Now, with central bank meetings this week, we've got Canada, we've got the FOMC, as we've talked about last week, we've got the Bank of England over the next 2 or 3 days. So, or the Bank of England on Thursday. So quite a lot to kind of ravel as we progress through the better part of this week. So, as I said, all eyes on basically the fundamentals this week. I think, yes, we will see some price action structure. We will be following the ladders very closely. But fundamentally, a lot of the price action will be driven around the news this week. And of course, as traders, we need to be very cautious of that. We need to factor in market volatility and, of course, understanding the ramifications of the spreads, which will widen on some of these events. Also with the potential for slippage on some of these extreme moves and extreme news. Now, my calendar has just filtered on to next week, so just bear with me a second, folks. Okay, brilliant. Okay, so you can see for yourselves that we are on the correct week. So as I said, tomorrow, a very, very data heavy week. We've got obviously European data out tomorrow morning with the UK prints on the CPI side. So that's going to be important, core and headline with retail price indexes. Of course, we also have European data as well tomorrow with the core harmonized consumer index prices. And then, of course, as we move into North America, we've got Bank of Canada meeting expected to cut by 25 basis points. And that's really the narrative. We have data prints before that in the US with the building permits and housing starts. But as I said, a lot of people are going to be watching tomorrow very, very closely. Now, mandate and expectation, if you were to look at any of the major sentiment websites, for example, like Polymarket, you will see that the Fed is expected to cut tomorrow by 25 basis points. And really, as we look at Polymarket, this is just the retail sentiment index. As of tonight, 24 hours beforehand, there is a in an approximation on this platform alone, we are seeing well over 150 million of retail volume into estimating what will happen on tomorrow's event. As you can see for yourself, 25 of the approximate 150 million has opted for that 25 basis point decrease, and of course that's what many on Wall Street are expecting. 49% have decided to, or 48 million, which is around about 33 or 30% of the total volume, has opted for no change in rates. So from a retail perspective, 51 have stupidly looked for a 25 basis point increase, and 50 basis points, there's over 37 million in volume on that. So there's a fairly decent spread across the board, but naturally enough, if you are in the know and you're watching things very closely with expectations, you'll see that the vast majority of people doing the research have obviously opted for that 25 basis point decrease outside of the three norms. Now, as I said, a no change for me looks very, very unlikely, despite those labour numbers. And I think the labour employment data over the last few weeks, particularly the revised NFP benchmark, which was 944,000 jobs lower in the recorded 12-month period, March to March, suggests that the labour market is far from optimum. And I think that really weakens the hand of the Fed to opt for that no change result. Now, I think it would be very, very surprising if we were to see a no change tomorrow. I think if we actually saw no change tomorrow, you'd actually see these indices really plummet lower. And that is really the Fed defying the President Trump's, I suppose, expectations and desires for this Fed to really cut rates aggressively. And as I said, when we look at the current expectations of 4.5 to 4.25%, we've been quite visible and quite vocal for a while that these rates have been far too high for far too long. And really last week we noted that realistically, for these economic conditions, with the NFP benchmark revisions for the inflation data, which last week came out, PPI well lower than expected and CPI in line, that this interest rate really probably should be somewhere around 3.5% or maybe slightly underneath that. So that shows as well, we've talked about how the Fed mandates has been utilizing for the last number of decades a lot of lagging and kind of out of date technical data in its calculations and in its kind of revisions of where rates should be. We saw it in 2020, 2021 when the inflation was out of control. They were very late in increasing rates. We then saw it in 2024. Again, similar scenario. They cut briefly last year, but really failed to follow that through for 12 months until the economy really started to show some of those fragile senses. So that for me is important. We know the Fed's mandate is stable prices and full employment. We know that's not been the case in the labour market. We know obviously the markets has done quite well. A lot of cryptos have made all-time highs or retested or at those all-time highs. For example, Bitcoin. We know the S&Ps has made continuous all-time highs really since around about the middle of June, when we had that kind of aggressive break of those February highs after that obviously decline in March and April, and that's obviously been noted aggressively, as I said, over the last 3 or 4 months, where we've gone from kind of 6,000 up to 6,600 on the S&Ps, which has really been in a runaway sense. So that's important obviously as well for context, that yes, stock markets are at all-time highs, S&Ps is at all-time highs, NAS is at all-time highs, Bitcoin got to all-time highs and has kind of accumulated a little bit more, just below the all-time highs. European equities in the first half of the year, all-time highs. Since corrected, Ethereum more recently, all-time highs, and just marginally underneath that. So that's really kind of where we are from a asset pricing perspective, and it's important to understand that tomorrow, yes, the mandate will be 25 basis point decrease, and I think the only really surprises that we would expect to see tomorrow is if the Fed defied the logic and didn't cut rates, then you would probably see actually the indices pulling back. So when you see the S&Ps tonight at marginally above 6650 depending on the exchange, the no change narrative really kind of undoes a lot of this aggressive buying that we've seen through August and into the first week and a half, 2 weeks of September. You would not be surprised tomorrow that if there was no cut in rates, you'd actually see the S&Ps back in the 64 handles, and that is really what I would look at if there was no change. Now also at 7 o'clock tomorrow evening, you've got the interest rate decision, which is the exact announcement. You've got the policy statement following up, but we also have the dot plot. And the dot plot is important because that's every second meeting, and it updates where the Fed expect the rates to be in the 1 year, 2 year, 3 year, and obviously the longer term perspective. So it looks at short, medium, and longer term perspectives where the rates are looking at. And you can even see yourselves that they are expecting those rates to be marginalized. And as I said, from dot plot to dot plot, it'll be interesting to see if there's any significant changes. As I said, the labor market has shown a lot of fragility, particularly after those revised benchmark numbers. Inflation is held up. It's gone a little bit higher, but overall not too concerning. Like, we know overall the US economy from a broader GDP perspective is holding up. So inflation matching GDP wouldn't be something to be totally concerned with when you see interest rates of 4.5%. So that's what we mean by there is that accommodation to see those rates go from that 4.5% down to 3.5% quite quickly. And that's exactly what we've seen kind of in prior dot plots. So it's important to have context. It's important to be able to look at those recent data prints. But ultimately, it's important to actually see what's the market believing. And as I said, there's a lot of people, and I think this is retail gambling sentiment, to say that there's 51 million people expecting rates to increase, for me, is absolute lunacy. I think that's just 51 million being thrown down the drain. So it's easy to see why poly market is doing so well as an index when you've got so much, I would say, retail dumb money looking for increases in these interest rates. For me, it's just like, it's complete ludicrous. But anyway, besides from that, as I said, the surprises for me tomorrow is no change, which you would expect to see the S&Ps probably drop quite significantly. As I said, 6400s wouldn't rule it out, but also at the same time, if the Fed went completely polar and opted to cut 50 basis points after the back of the benchmark numbers on the NFP more recently, then that really opens up the QE side of things, and really you could see this S&P go to 67 quite aggressively and maybe potentially above it. So as I said, 25 basis points is what's priced in. You've obviously got the buy the rumor, sell the fact, because the markets has gone up pretty much through August and through September from 62 to 6600. So there's a lot of expectations that this is basically factored in. So the 25 basis point increase for me is already factored in, which obviously gives the risk that if the policy report, policy statement, or any sort of rhetoric doesn't conform and back up for a dovish move by the Fed to keep these markets propped up, you could have a buy the rumor, sell the fact scenario also. And that is something to be very cautious of, given how extreme these markets has been over the last kind of 6-8 weeks. As I said, we've gone from the 1st of August at 6200, 6250. Tonight, as we speak, we're above 6600. So that's a 350 point move in a matter of weeks. And if you look from peak to trough, you can see for yourself that that's a 6-7% move in 6-7 weeks, which basically is a percentage a week, which shows that there's a lot of this preempting the Fed cutting the rates as well. So we also have to be conscious of the buy the rumor, sell the facts scenario, given that it's been absolutely no surprise that everyone is expecting the Fed to cut by 25 basis points tomorrow. All right. So as I said, tomorrow is going to be very interesting on multiple facets. As I said, the buy the rumor, sell the fact scenario. Does the policy statement prove to be more accommodative, reiterating that more cuts are coming? The dot plot again is also going to be very, very important. If we see that dot plot even reduce those existing levels down, so let's say for example the 1 year dot plot goes from 3.6 to 3.2 or 3.3, the second year goes to 3, the third year goes to 2.8, let's say for example, that is also a bullish statement for these markets, because it shows that the Fed is committed in its mandate of actually getting these rates lower, in line with probably where they should be within the real economy. And that is also a very important note as we move into tomorrow's FOMC. So dot plot for me is important. Policy statement and rhetoric is important. The initial decision, obviously, we know is going to be important. And then, as I said, the follow through to see how these markets prop up after this announcement at 7 o'clock into 7:30 as Fed Chair Powell steps onto the stage, and really determining whether these markets actually close stronger into, let's say, 9 o'clock cash market open in the US. Okay, so as I said, busy day tomorrow in Europe. US for me, I think, is really going to hold still until 7. You might see a little bit of volatility at 1:30, maybe a little bit of open interest at 2:30 in the open with the BOC and obviously the Fed at 7 tomorrow. I think a lot of people will be holding the powder dry. Me personally, I'm not going to get sucked in too early. Don't want to be using up all my ammo and positioning ahead of the FOMC, and then with the potential of maybe getting caught offside, carrying maybe a little bit of drawdown. Nobody wants to be carrying drawdown into an FOMC meeting where the Fed is expected to cut by 25 basis points, but also where we're getting a dot plot. That is worst case scenario. And I would actually say that if you were trading into FOMC and you were in drawdown, and just be very, very careful, because you could lose your account very, very quickly if the volatility sparks up. Okay, and then of course as we move to Thursday, again more European data prints Thursday morning, a little bit less significant because it's mostly speakers, the Bundes report as well, the monthly report. And then of course as you move into Thursday, the Bank of England is expected to leave rates at 4%. This for me is quite interesting because of course the last one was 5 and 4, was far from comprehensive, as the Bank of England cut to 4%. This time around they're expected to hold rates, with 2 of the 9 expected to vote for a cut. The other 7 is expected to remain unchanged. And I suppose we can do a little bit more of a dive on that on Thursday. Tomorrow evening or Wednesday evening as we move into Thursday. But as I said, the Bank of England is a little bit more neutral in its approach, despite obviously cutting rates. Europe is very much winning the race to the bottom against the Bank of England and the Fed. The Bank of Canada has also been aggressive in its cutting rates as well. So Bank of Canada in Europe is moving aggressively to the downside. Aussies and Kiwis have followed suit more recently. But the Bank of England and the Fed are much higher in comparison to the other 3 or 4, which is going to leave Thursday's interest rates very interesting, because of course if the Fed were to cut rates tomorrow by 50 basis points, it actually opens the door for maybe a little bit more flexibility by the Bank of England. Because if the Bank of England governors, me personally, if I'm a governor in the Bank of England and I'm seeing the Fed potentially cut by 25 or 50 basis points the day before, that for me should prove that maybe we need to be a little bit more accommodative. And as I said, more particularly so on the 50 basis points side of the equation. Okay, so just be very, very mindful of that. As I said, 2 very, very busy days. And then, of course, on Friday, we've got the BOJ expected to leave its rates at 0.5%. But with the Bank of Japan, it's more geared towards policy statement, and then its mandate surrounding the purchasing of JGBs, which is the Japanese government bonds. So that for me is going to be probably more important than the interest rate decision itself, as it tends to be in Japan itself. But as I said, we've got the Fed, we've got Bank of Canada, we've got the Bank of England, we've got the BOJ. 4 of the big 7 or 8 central banks all meeting this week. And then, of course, on Friday morning, after all the dust is settled, we've got German PPIs, UK retail sales, and, of course, Canadian retail sales with mixed bits and pieces out in the thing as well. Now, we've obviously got the BOJ press conference at 7:30 on Friday morning. That'll be interesting, of course, as that'll lead into European Open. So where does that leave markets then? It obviously leaves markets quite tepid. Obviously, we've seen the S&P get to new all-time highs, 6600s, which was really my year-end target. When we were at 62s in February, I was kind of expecting that by the back end of this year we would be at kind of 65, 6600s was kind of my base case scenario. Even when we were down here and the markets was starting to show signs of recovery in May, when we were 5600, I was still expecting. We put out even surveys into our Telegram group as well of where do you expect the S&Ps to go this year, and it's actually no surprise that a lot of the students as well who participated in that was looking at kind of 64, 65, 66. I think there was even 1 or 2 that even went 69, 7,000, which is quite interesting. So we're kind of hitting the ballpark there. In terms of where the S&Ps is. It's just, I suppose, the fact that August has been quite bullish, which we tend to see. Obviously the seasonality factors, vacations, people going away on holidays, markets tends to grind higher traditionally over the last 4 or 5 years during the summer period. But what's been more surprising is that the September low was marked really at the beginning of the month, and since then on the 1st, 2nd, we've gone from kind of 63, 6400s all the way up to 66, which is again showing that on the upside this market has been incredibly nimble and agile on the upside. Now, as I said, tomorrow there's a lot of buying emphasis already. Are we going to buy the rumor, sell the fact? We've seen no sort of real recovery from when we broke 65, so we could even see a buy the rumor, sell the fact where market comes back down to that 6500 handle, and that for me would be something that would be a little bit kind of cautious of, considering of course that we'd bottoms, as I said, at the start of September. We've had new highs, we had the structural pullback in NFPs on the 5th, then of course we've had that aggressive movement on Tuesday and of course Thursday of last week, and since then it's just been a steady grind higher. Tuesday bullish, Wednesday bullish, into Thursday where there's a little bit of a corrective move, Thursday, very bullish, flat into Friday. And then, of course, Monday into today, we've been bullish again with a corrective movement today. So again, showing the, as I said, upside dominance of this market at the minute. And we've got a very, very similar story in the NASDAQ, right? This is a 30-minute print, but even from those all-time highs, we had this aggressive August dip, which was known. We had the new highs. We've had the structural bottoms here around the 23s, which we even spoke about 2 weeks ago. And then from there, it's just been grind up, a little bit of a reaction off the NFP print, similar to the S&Ps, gets to all-time highs, creates the pullback here on the value area on the 8th, which was last Monday. And then since then, over the last week or so, it's just been steadily accruing upside momentum. And you can even see that over the last week as well, how aggressive this has been. I even have to zoom in my screen because it's been that bullish. So we've gone from 23.8s up into 24s, back down, reaction from the value area, accrued that on Thursday very, very nicely. Friday held those structural lows. Now this was the pre-existing value area on Friday. As we were doing our wrap-up zoom on Friday afternoon, this was really kind of where price action was eyed from. And of course, by 2 o'clock, half 2 on Friday, this market just continued to exuberate higher into 3 o'clock. And disconnected there briefly. So that's what we're saying there, is don't expect to just go straight line green up, given how extended it's already been over the last kind of 2-3 weeks in particular. All right, and this is kind of the fragility, because of course you look at the Dow Jones, very underperforming relative to the other two, has got to new all-time highs more recently, and this is kind of what we were talking about last week. That 45.4, 45.5 handle held beautifully last Tuesday, last Wednesday, into last Thursday from that Monday open, which we talked about. It got the all-time high on Thursday, and then we talked about it on Friday, getting that move back down, which it did very aggressively, and we talked about how could it actually come back down into this 45.5, and we actually said that that was probably more the possibility of it undoing and undoing this aggressive move that we saw on Thursday. So Thursday apexing up, Friday falling in itself on an arc into the Friday close, Monday quite mixed, Tuesday quite bearish, and basically holding at a retest level of that all-time high. So this was the all-time high here. We had this break initially, then we've consolidated, we've broken up, and we've come back to retest. So that's really going to be interesting to me tomorrow. If we break under that 45.7s, most likely we come back to that 45.4, 45.5 again, which is really worth looking at. And that for me could be the inducement on the apex, coming back down, finding the value area. In smart money concepts, you'd say it's a fair value gap fill, basically the fulfillment of this aggressive imbalance on the upside, coming back down, mitigating, closing it out, and fulfilling the order flow. But also when you look at it from a volume-based perspective, you can see how much volume is here around that 45.4, 45.5, and that for me is going to be very interesting. Although we've broken through it initially today, we're kind of sitting at it and just sitting above the revised value area in the session, which is around that 45.750. So that for me is going to be important tomorrow if you trade Dow. I won't be touching Dow myself. For me, it's going to be a case of if there's an arcing unwind on the S&Ps, on the NAS, or if it's going to be a straight continuation to the upside. I've had a further revised idea that we might see 6,900 by year end. It's kind of an idea I've been touting. My first target at 65, 66 has been met, which is obviously very important. But I'd like to see this, if the Fed is going to continue cutting rates September, and potentially moving on more further into Q4. That will really kind of ramp home. Now, if we look at the October Fed decision, now obviously it's October 29th, so it's still some time away. We're still talking kind of 6-7 weeks away currently. You can see that there's a 25 basis point decrease by 72% of participants. So there's 336,000 of volume. Now, again, smaller volume, 25 basis point is over 3.1 billion. So again, these people are in cuckoo land. 336.5 million. So it shows that even now the underweighting is there's probably a little bit of value there in the 25 basis point decrease for October. So that'll be worth kind of looking at. Only 72%. I would be surprised if we didn't see that at 90-95% if the current economic condition stays the same and the Fed cut by 25 basis points tomorrow. If the Fed cut by 50 basis points tomorrow, the likelihood of an October cut is probably going to be pared back, which you might see the no change get up into that 30-35, and then you might see a split decision between the rest, 50 and 25. But overall, let's take it decision by decision. We are expecting 25 tomorrow. I would be surprised if we didn't see kind of 2 to 3 cuts by year end. So that's obviously September, October, and December. We've 3 interest rate meetings left. Could we get 3 25 basis point cuts? Could we get a 50 and maybe a 25? Let's see what happens. A 50, a hold, and a 25 could be possible. So we've got 3 very, very important interest rate meetings coming up by the Fed, really to try and save face, because we know the Fed has been ridiculously behind the curve over the last 4 or 5 years on every cycle, regardless whether it was the inflation cycle, the inflation decreasing cycle, the current macro conditions with the trade war and everything going on with the US and its global partners. It doesn't really matter. The Fed has been completely behind the curve at every stretch. That is obviously something to factor into consideration. Now, as we move out of the fundamentals, we've been incredibly fundamentally driven tonight. We need to obviously look at where the markets are at. Now, last week we saw that DXY breakdown initially. We got to move back into that 98. 98 proved to be a ceiling. It was kind of a short-term mitigation of this area here. Didn't really fail to get above 98s even on Thursday. We saw it slump on Thursday into Friday. When we're doing our weekly recap on Friday, we were getting these wick rejections, and I said this is something to just be very, very careful of, because as I said, if we break 97.5 on Friday, we talked about it, it could bring in more downside, and lo and behold, that's exactly what happened. That break of 97.5 was the trigger point. We retested those previous lows from Tuesday, which was down around about 97.25. That fell away like a floor very, very early or very, very late last night during the Asia session. The DXY completely unraveled on itself. We broke through the 97.25 handle, straight through 97 like a hot knife through butter, and we've continued to move aggressively lower, where this DXY has now faltered back into those prior lows. So this was really kind of the enveloping break, and really from here it's 96.5 for me is going to be pivotal. When you look at that broader cycle, yes, we've talked about the idea that when the Fed start cutting rates, we talked about it last year, when the Fed cut rates last autumn, the dollar actually rallied. When they did it in 2017, 2018, the dollar actually rallied subsequently. But it'll be interesting to see if there's a little bit more downside. That 94 handle, 95, 96.5, it'll be a very, very interesting couple of days to see whether we get further downside. But even when you look at the price action in the higher time frames, it is still emphasizing more pressure on the downside. So that is obviously something we need to be careful of. On the daily itself, it's closing quite bearish. On the weekly, obviously, there's 3 Wednesday, Thursday, Friday. There's 3 trading days left. We could very easily repeat what happened in July. Wick down, bounce off it. And if that was to be a wick bounce, you'd actually probably get a fairly strong counteraction, which would mean probably phasing some of that risk. Seeing a little bit of a pivot in the VIX, which we've already seen tonight. There's a little bit of a clue there tonight and yesterday. The VIX is kind of pivoted from that 14.5 up to 16, so the VIX is already popping up a little bit today off the back of that, despite the S&P's holding pretty well since the beginning of the week. It's gone up and it's come back down. The NAS, it's gone up and gone back down, but the VIX is still holding a little bit of a headwind into the FOMC meeting. So as I said, that's going to be very interesting. If you look at the VIX in a higher time frame, just for scope, we know that there's been a lot of emphasis. So if you go back to 2024, when the Fed was decreasing rates in 2024, the VIX kind of rose from kind of 15 to 23. Now it's already started increasing. Is this the bottom in the VIX? Are we going to get a little bit of a counteraction? And as I said, something very, very cautious to see is we've seen a lot of preemptive buying. If we start to slip away tonight, is there going to be a little bit of an unwind? And again, the VIX is going to help with that. The DXY over the next couple of days is really going to help with that in terms of ascertaining kind of fundamental bias. Now, as I said, very, very weak into the FOMC over the last couple of weeks. When you look at from, let's say, the beginning of September, where we've gone from 98.5 down to 96.5, decent 2-point move on the index, but we could very easily be bouncing off that by this time tomorrow night. And of course, we'll be on the wires tomorrow night. We'll be on the wires Thursday for US Open in the midst of the Bank of England and after the Bank of England meeting. So we'll have a very good idea on Thursday how these markets are pivoting into month end. And I think that for me is going to be very, very, very interesting, because we know traditionally September is a tricky month. We've had a very exceptional start to September this month with indices up kind of 4 or 5%, down maybe a little bit less. European equities are on the back foot, but we've talked about that kind of counter-cyclical rotational play. So of course it's going to be very interesting to see how this unfolds as we move into tomorrow. VIX, as I said, is already picking up, and for me there's an amber light there, a warning light there to say this might pick up again even further. And if it does, above 17s, above this wick area from Friday on the NFP data print, really brings in increased vol. If there's increased volatility, we actually know that the equity markets tend to be more leaning towards downside progression. And as I said, we have seen it accrue aggressively, and it's already looking at kind of creating short-term tops. So let's see what happens there. If I was a betting man, I think if this value area gives away today and yesterday's value area gives way tomorrow around 66s, we immediately come to Friday, which is around about 65.70, and then of course there's really that continuation or undoing apex where price action could come back down into that 64.50, 65, and that's what I would look at if markets were rotating tomorrow for a little bit of weakness. Same again in the NASDAQ, very interesting movement. Could we see a rebate or kind of regarnishing down into those 23.6s, 23.7s, 23.8s? Really wouldn't surprise me at all, given how aggressive this movement has been. Of course, this is where we had our September bottom with a little bit of a V in here. We broke out, we held above it. So for me, your option in here that if markets was to turn negative, if we were to see that VIX kind of aggressively move higher, you've got that retest of lows here, 23.8s, 23.9s. You've even got 23.4s if we were to get another pullback, like what we've seen at the beginning of August and like what we've seen at the middle of August and early part of September. So just be conscious that markets are moving in both directions. So when there is a period of price structure or price discovery like this, there tends to be kind of a knee-jerk reaction. So whether we get it tomorrow or whether we get it maybe in a couple of weeks' time, obviously let's wait and see. The narrative will be poised whenever it develops. All right. The Dow is very similar. It's already kind of breaking down. As I said, I really would not be surprised if we saw the Dow tomorrow at 45.4, 45.5, or even maybe 45.2 if negativity set in. So again, I'm using that VIX index very closely over the next 24, 48 hours to see, because as I said, if we see this VIX moving higher tomorrow, for me, there's no reason not to want to hedge out some of this risk. And as I said, look for weakness in these equity markets, okay, at least temporarily. But obviously let's wait and see what happens. Gold prices, it was in a period of consolidation for that last week or so. Monday, Tuesday, Wednesday and Thursday of last week. Friday was obviously quite consolidationary. Monday we broke up again into that 3700 handle. From there today, markets has been poised in and around that 3700 level. So consolidation, breaks out again, literally no pullback or retest or any sort of unwind following the breakout of 36.40, and this is kind of where we're at. If we see a little bit of an unwind tomorrow, if we were to see maybe a pickup in dollar strength off of those lows, let's say 96.5 holds, and we get a little bit of a bump back up to 97.5, that might be the apex for gold prices to arc up and then come back down. If that does pivot itself, you're really looking at price action taking out these structural lows, which is lows of today around about that 36.75, and if we do break that, you would immediately be looking for price action to come back down into this value area here. And you look at last week, markets very poised around here between kind of 36.30 and 36.50, so that would be the kind of the correction on that. But gold very, very bullish at the minute. be mindful of that if you were to take shorts on gold, you would actually be trading against the longer term trend, which is really never a place you want to get into, particularly if the market keeps going higher, because it's just going to lead to more drawdown. But gold markets at the minute, very, very progressive. The FX side of things, obviously with the DXY weakening over the last few days, we have finally broken out above this 117.50, and that for me was quite interesting because we got a little bit of a break last week, failed to really break above, then we got the pullback, then we kind of faltered, then we kind of hung around that 17.50 handle, and then of course Monday this week we got the break, and as of course last night, as that DXY moved lower, the euro dollar ultimately peaked, moving to its highest point. Now when you go to the daily as well, quite an interesting structure. I suppose if you were to look at the daily like that, you'd actually see it's a little bit more tied. Daily, daily, daily break, retest. The only problem is you probably would have actually liked to see this go above. So the opportune move there would be the euro dollar to come up, come back down, and then springboard. But on the daily there, quite an interesting move out of this consolidation. And euro dollar for me at its highest point since, let's go back. It's at its highest point since August of 2021 as it approaches, or as it closes into tonight above 118.50. Cable prices is basically retesting those July highs. So we had that July peak and trough movement, 137.50, only to come back down into this yellow area. We then of course had this V-shaped bottom, price deliberated here in the 135s. A lot of volume here between 134 and 136 over the last kind of couple of months, excluding this break up here and including this V-shaped move down here, which ultimately just returned back up into the value area, which was, as I said, mostly around here. So that for me is kind of where volume has been trading at on the pound for the last few weeks. It'll be interesting to see this week, how does that react? Does it ultimately go higher, ultimately trying to take out the 137.50s, or if we completely dial things back, I'm going to remove all the drawings for a second, look to our weekly chart. It's now in pivotal form to see how does it react at this 137. I think this is going to be a busy couple of days to see on cable whether it goes above this 137.50 handle. Now again, this is back to where we were. Longer term expectations was to see the DXY go 92.94 on the index, really try and find bottoms, then Fed to start cutting, cable to get into those high 130s, 138s, 139s, ultimately try and inflect off of this area of price over here, and then start to undo. So we're still in that phase of price structure, but if you look at even on the higher time frames, this 142.5 also proves to be 142, 143 proves to be a pivotal area. Every time we've come up into this zone, we have very aggressively bounced. So even above 137, there's more ammo for this to go slightly higher in the next coming weeks. So interesting to see what happens with the Fed cutting rates, the direction of how they cut rates, the frequency, also the velocity around the rate cuts, and factoring in as well, monetary supply is going to be something that we're going to focus on quite heavily as we move into Q4, October, November, December. We've seen M2 pick up quite aggressively anyway, but it's something that we're obviously going to focus more on as we move into, as I said, Q4 overall. So that's really kind of where we're at the minute. Markets, considering everything for seasonality factor, September and so on, S&Ps, NAS doing incredibly well. Will that be the case tomorrow? Only time will tell. The Dow Jones got to all-time highs. It's corrected back down. The dollar has shown significant signs of weakness as it's retested those lows, which has allowed that euro-pound play to go higher. Europe isn't something that we've kind of talked about too much because we have been expecting weaker movements in the DAX. It's something that I've been quite vocal on for the last few weeks. We got that initial move. We've kind of in a period of pause. And today, of course, with that euro dollar moving higher, the DAX has been absolutely smashed from that 23.8 down to those low 23s. And it's instigating a break below this kind of 23.5 handle. So that's going to be interesting. We did kind of talk about how aggressive the DAX has been in the first part of the year, first 6 months of the year. You take a step back, and it certainly looks like the DAX has a potential for going a little bit lower. But it really depends on the euro dollar. If this euro dollar continues to pick up a little bit of steam, let's say it goes to 119, 120, 121, well then you'd actually expect the DAX on the back foot to probably move lower. And we talked about the idea that we've had this apex V-shaped bottom, aggressive move, and if you compare it to the likes of the S&Ps on the weekly, it too has been quite similar. But when we had it, there was a little bit of volatility in here before it took off. Now, S&P's is replicating the same type of cycle that we saw in the DAX in Q1. And I think it's just what's actually happening in the S&P's. It's a later cycle move compared to the DAX. So I think what will happen eventually is DAX will become corrective. S&Ps will probably take higher. The S&Ps then will on arc. I think that will probably be a play into the back end of next year. Create maybe a down year, create a correctional flow. But repeatedly look at maybe repeating this type of formation where it arcs, becomes more consolidationary, and then maybe starts to see a little bit of risk aversion. So the S&Ps has been very aggressive in the last 3 or 4 months, like too is the NASDAQ. It'll be interesting to see whether this rotation continues to pick up into year end. And as I said, I certainly wouldn't be looking at buying DAX or buying European equities as much as I'd favour buying the likes of the S&Ps, the NAS, the Dow, when we see the Fed cutting rates, when we see monetary supply picking up. So the macros and the fundamentals are much more supportive of US denominated assets outperforming European or other jurisdictions in the back end of this year. All right, so that's kind of where we're at. Crypto cycle. Obviously, we've seen Bitcoin move back up into the 117s from that 113s. It's kind of hung about the range between 115 and 117 since pretty much the early parts of last week. Peaks and troughs consolidating. 117 proves to be high, so you can even draw that as a short-term top for this evening into tomorrow. Very interesting to see how that reacts. Ethereum got the break again. It's kind of faltered back on itself. For me, this is very interesting because Ethereum apexing again, shoots, takes the highs, comes back down, mitigates the value flow. Even this wick here on Friday just of NFP was perfect. Consolidates, aggressively breaks out, comes back, and really starts to kind of mitigate where price action starts to aggressively move. So we're kind of arching up high, low, and then of course imbalance. Price action comes up, comes all the way back down, and holds this beautifully. So for me tomorrow, if the Ethereum play can hold above that 4,400 level, and we see maybe even risk denomination coming back in where S&P's, NAS goes higher, maybe some positivity coming back into the markets again, you'd actually expect this is the play to happen. So you'd expect maybe Ethereum to bounce off of that 44, move back up into 46, 47s. If we see the inverse, we see risk aversion, we see undoing of that. If we see a pickup in the volatility index, you'd ultimately expect this 4,400 to give way and probably come back down again into these lower bounds. So 42, 42.50, 43s would become a very, very interesting move. And as I said, that's going to be gauged around the VIX, the volatility curve. So keep an eye on the volatility curve. If the volatility curve is increasing, look to segment and diversify your risk. If the volatility rolls over, well, then you know we're risk on, which means equities, crypto, any sort of risk denominated asset should do quite well. All right, so it's an important week this week on all fronts. Let's see what happens overall. 3 very, very important meetings with the Bank of Canada, the Fed, the Bank of England. You could even add in the BOJ on Friday with a little bit less significance. So you've got 4 big meetings this week. So let's see what happens in the face of that. We will be back tomorrow. I will be back for US Open tomorrow. We've got the Fed meeting tomorrow evening. And then, of course, back for US Open on Thursday, which kind of really is the aftermath of Fed and, of course, the Bank of England on Thursday afternoon before that. Okay, so really what I would say as a parting comment, just be mindful of risk this week, everyone. The last thing you want to do is get too ahead of yourself, really then have euphoria, think you're the biggest and best trader in the world, and then the chickens come home to roost and you are left licking your wounds. And the last thing you want to be doing is trying to chase losses into Friday, because if you are down, let's say Wednesday, or you were down Thursday and you're trying to catch up into the weekend, that is often where a couple of small losses tends to lead to big losses. So let's just see how things go. Risk management to the forefront of your strategy. Important to understand the fundamentals, understand the recent movements as well within these markets, like what we've discussed tonight. Not getting too ahead of yourself and expecting further increases before things have been actually determined and realized. And I would actually pay more dividend, less on the 7 o'clock announcement, because that we know that's going to be algo related anyway, and more on the FOMC as we go 7:30, 7:45, and into that all important 30-minute close, 30-minute print, volume print close at 8 p.m. as we move out of the press conference. Okay, so that's where we're going to leave it tonight. As always, trade safe, everyone. Have a good evening, and of course, we'll see you all tomorrow for the prelude.